Good morning, everyone. I'm excited to welcome you to today's presentation. We'll be exploring 5 Indian stocks that won't be hit by U.S. tariffs. The focus is on investing in domestic consumption for a tariff-proof portfolio. Over the next few slides, I'll walk you through which stocks to consider and why they're resilient. Let's get started. Let's take a closer look at the current tariff situation. Recently, we've seen tensions around tariffs that are causing quite a bit of volatility in the global markets. However, it's important to recognize that not all Indian companies are impacted equally. For example, export-oriented sectors like IT services and textiles are feeling the pressure more directly because their revenues depend heavily on international trade. On the other hand, companies that are more domestically focused are actually outperforming. Their primary revenue comes from Indian consumers, which shields them somewhat from these international trade tensions. This distinction is really crucial for us when thinking about building a resilient investment portfolio. Understanding which sectors are more vulnerable and which are more insulated helps us make smarter, more informed decisions in a volatile environment. This context sets the stage for the overall theme of navigating risks while identifying opportunities amid these global shifts. Let's take a closer look at Sector 1, which focuses on banking and financial services. Companies like HDFC Bank, ICICI Bank, and Bajaj Finance primarily serve Indian customers, and their revenue streams mainly come from the Indian market. This includes interest income, fees, and charges, so their success is closely tied to the health of the Indian economy. Starting with HDFC Bank, over 95% of its business is domestic. This high level of focus on the Indian market shows its resilience, especially when global trade fluctuations happen. It demonstrates how well-positioned HDFC Bank is to withstand international uncertainties because its core operations are rooted locally. Moving to ICICI Bank, it has an extensive branch network and robust digital platforms. This wide reach allows it to serve a vast Indian customer base efficiently, making banking accessible across urban and rural areas alike. Their digital initiatives are especially important as they cater to the increasing demand for convenient, tech-enabled banking services. Finally, Bajaj Finance is experiencing impressive growth, driven by India's rising consumer credit demand. Their focus is on personal and consumer loans, tapping into the increasing financial needs of Indian households. This growth reflects both the expanding middle class and greater financial inclusion in the country. Overall, these companies illustrate how the Indian banking sector is thriving by leveraging domestic strength, digital innovation, and growing consumer demand, key themes that tie into our broader discussion of emerging markets' potential. Let's take a closer look at Sector 2, which is the fast-moving consumer goods, or FMCG. This sector includes some of the biggest names in India like Hindustan Unilever, ITC, Nestle India, and Dabur. These companies primarily sell everyday essentials such as soap, shampoo, biscuits, and other household staples. These are non-discretionary items, meaning people buy them regularly regardless of economic fluctuations, which provides a stable revenue stream. Most of their revenue comes from domestic consumption, highlighting how deeply they are embedded in everyday Indian life. For instance, ITC isn't just about FMCG. It also has strong businesses in hotels, paperboard, and agriculture, which helps diversify its income sources. This diversification acts as a buffer, especially when it comes to tariff impacts or other external shocks. Overall, this sector's focus on daily essentials and diversified business models makes it a resilient part of the broader economy, reinforcing the theme that certain sectors can provide stability even in changing economic conditions. Let's take a closer look at Sector 3, telecom and infrastructure. When we consider telecom giants like Bharti Airtel and Reliance Jio, it's interesting to note that they generate 100% of their revenue domestically. This means their entire revenue comes from serving India's massive user base. Their growth is closely linked to India's ongoing digital revolution and the rollout of 5G technology. Because of this, they are essentially immune to U.S. trade policies, which is a significant advantage in today's global environment. Now, focusing on telecom growth, it's driven largely by domestic demand for connectivity and digital services. As more people come online and seek digital solutions, these companies expand their networks and services to meet that demand. Shifting to infrastructure development, companies like L&T and cement producers such as Ultratech are also playing a crucial role. They are building infrastructure specifically for India, and their growth is fueled by supportive domestic policies and demographic trends. Overall, this sector exemplifies how India's domestic focus and policies are powering growth in both telecom and infrastructure, reinforcing the broader theme of self-reliance and digital transformation in the country. Let's now take a closer look at Sector 4, retail and consumer discretionary. Companies like Avenue Supermarts, known as D-Mart, and Trent are prime examples of purely domestic players. They focus entirely on the local market, which means they rely heavily on local supply chains to meet consumer demand. Because of this, they are largely unaffected by international factors such as import tariffs or trade disputes, giving them a certain resilience. In fact, about 80% of their sourcing is local. This high reliance on local supply chains helps them stay agile and responsive to domestic market needs. The Indian retail market itself is experiencing massive growth potential, around 60% market share growth, simply driven by domestic consumption. This means there's enormous room for expansion as more consumers come into the fold and increase their spending. Another key point is that these companies maintain a strong domestic focus, with about 95% of their operations centered within India. This focus shields them from international import costs, such as those from Amazon or other global players, and helps them stay competitive on price and availability. Overall, the Indian retail market's vast untapped potential, combined with rising disposable incomes and an expanding consumer base, promises sustained growth. This sector is really a testament to the strength of domestic demand and the opportunities it presents for long-term investors. Let's talk about some important risks to keep in mind. No stock is completely risk-free, even if these companies seem insulated from trade wars. They can still be affected by broader economic factors that impact the overall market. For example, general economic downturns can affect all stocks, regardless of their specific sector or location. Then, there's currency fluctuation, which can influence input costs, even for companies that operate domestically. If the currency shifts unexpectedly, it can impact their profitability. Another factor to consider is a slowdown in the domestic economy. When consumers spend less, it naturally curbs growth for many businesses. Additionally, changes in RBI interest rates can influence borrowing costs, affecting both consumers and businesses when they take loans. Despite these risks, it's important to remember that the core fundamentals of these businesses remain strong, largely because they rely heavily on domestic demand. So while there are risks to be aware of, their strong domestic focus helps mitigate some of these broader economic impacts. When it comes to building a tariff-proof portfolio, there are a few strategic approaches that can really make a difference. First, diversification across sectors is crucial. By spreading your investments across banking, FMCG, telecom, and retail, you help mitigate risks associated with any single industry facing challenges. This way, your portfolio becomes more resilient to sector-specific downturns. Next, using systematic investment plans, or SIPs, is a smart move. They allow you to invest consistently over time, which is especially helpful during volatile market conditions. This disciplined approach helps smooth out your investment journey and reduces the impact of short-term market fluctuations. Another key point is focusing on companies with strong fundamentals. Look for those with robust management, consistent profits, and a growing market share. These qualities often indicate a company's ability to withstand economic shifts and continue performing well over the long term. Finally, keep a long-term growth perspective in mind. Remember, the growth of these stocks is primarily tied to India's resilient domestic economy, rather than global trade tensions. By staying committed to this outlook, you can better weather short-term uncertainties and capitalize on India's ongoing economic strength. So let's wrap up with some key takeaways. First, it's important to recognize that certain sectors in India are relatively insulated from U.S. tariff policies. This means they might be less directly affected by trade tensions and could offer more stability. These insulated sectors include banking and financial services, fast-moving consumer goods or FMCG, telecom and infrastructure, and retail and consumer discretionary. Now, within these sectors, there are some notable companies worth researching further. For instance, HDFC Bank, which is a major player in banking, ITC, a leader in FMCG, Bharti Airtel in telecom, Ultratech Cement in infrastructure, and Avenue Supermarts, also known as D-Mart, in retail. Remember, while these companies look promising, always do your own thorough research before making any investment decisions. Consider your personal risk tolerance and investment goals. The overall message is to stay informed and cautious, especially when navigating the complex global trade landscape that can impact markets in unexpected ways. Before we conclude, I want to emphasize a few important points. This presentation is meant for educational purposes only. It's not intended to be financial advice, so please keep that in mind. The information I've shared is based on general market conditions and analysis, but individual investment results can vary widely. It's always a good idea to consult with a qualified financial advisor before making any investment decisions. Doing your own thorough research and due diligence is crucial to understanding the potential risks and opportunities of any investment. Remember, investing in the equity markets involves risks, including the possibility of losing your principal. So, approach investing carefully and responsibly. Thank you very much for your attention today. I appreciate your interest and hope you found this information helpful as you move forward with your financial journey.